Hello there, this is Hustle Muscle. If you're new here, I'm an ordinary 37-year-old Singaporean trying to be disciplined when it comes to investing. I've got a regular full-time job, I live in an HDB flat, I don't drive, and I'm just trying to build a solid investment portfolio for my future self. In my last video, I shared that I invest $1,500 every month and do side hustles to make sure I can fulfill this target amount. And a few of you left comments asking about the nature and frequency of such side hustles, and also how do I choose which dividend stocks to purchase. So today, I want to answer both of those. I'll walk you through how I budget my salary, where the money comes from, and then the responsibilities that I have to fulfill and where these money will start going from the pie, and then also how much do my side hustles contribute separately. Then I'll dive into why I chose dividend stocks, and let's go into the first bank stock I bought, OCBC. Just a disclaimer that this video is not financial advice, it's only for information purposes and for my own tracking only. Now, this is a breakdown of the salary that comes in and how I allocate into different pockets within my life. My gross is 7K and my net salary after CPF deduction is 5.640. 26.6%, or close to 30%, goes into investments. I'll chuck it aside for investment purposes. And the next big one is actually for my parents. I give my parents allowance. And then for personal spend, this includes my lunch outside, my daily lunches, and occasionally some nice treats here and there. For my flat, internet, electricity, and town council, this amount is split between my wife and I. We pay $550 each for this, and for emergency cash, I set aside $500 a month, and I put this into another account altogether. For insurance, this is $420. This includes my critical illnesses, my MediShield insurance, and life insurances. For bills, I consolidate these two categories together: groceries for home, which is $400 a month, and home subscriptions like Netflix and other phone bills for the home. This adds up to $480. And for health and wellness, this is my Anytime Gym fitness memberships and my Muay Thai gym memberships. My transport, because I commute publicly, it's $250 a month, and my taxes is $186 a month that I pay on a gyro plan. In the month of June, I didn't have enough time to do a lot of freelancing because of my day job, and this contribution is $300 for the month of June for one gym. In July, I am able to afford more time, and I'll be doing it in two gyms with more time slots. So I'll give more updates on what are the contribution rates and how much would be for the month of July. Now that you've seen how I allocate what comes in from a salary standpoint to the different pockets, be it investments, flat payments, and even emergency cash, let's address the other comment of how I choose the stocks that appear in my portfolio. Primarily, I have two portfolio pots. The first one is the pot for dividend stocks, and then the other pot is basically the S&P 500 based VOO tracker, right? That is on the Nasdaq. For dividend stocks, I generally have a few criteria that I go for. The first one is that the dividend yield has to be around 4 to 6% to make it reasonable for returns. The other one is that the companies that I chose should have a history of paying and increasing their dividends, and that the most important part is that they've got financials strong enough to support future payouts. Now let's talk about the first bank stock that I bought with what I had for the portfolio. It is OCBC. It's not that I don't want to buy the other bank stocks, don't get me wrong, it's just that I'm poor. I do like the Singapore stocks for the banks that we have in Singapore. All three bank stocks are very strong, and I think let's talk about OCBC first, and then I will give an overview comparison of what I do think would be my next purchase for bank stock if I had more resources and what have you. All right. Now let's talk about OCBC. Over the last 5 years, it has done really well for its shareholders, returning close to 80% compared to the market's close to 50%. However, year to date, it has underperformed the market by returning a negative 1%, while the market is up close to 6%. It has a forward dividend yield of 5%. Historically, its payout ratio is between 50 to 60% range, and in May, actually, it has reached a forward dividend yield of 6%. However, street consensus has a target price of an average of $17.14, representing about 4% upside. However, you can see that different houses have different opinions, and this ranges between $14.40 to $19.30. If it actually ever falls to this price, I think I would accumulate. I wanted to show you its price to book ratio. Price to book ratio currently stands at 1.29 with its historical average of 0.94. It's higher, but when I compared it with what the two other banks locally are at, I think it's within a range that's acceptable. Why do I use price to book ratio over PE, price to earnings? It's because banks deal with loans, deposits, and capital reserves, so the book value reflects real net worth. A price to book ratio of 1 means you're basically paying dollar for dollar for the bank's assets, and OCBC's one currently stands at 1.29. So yes, it's a little bit over, but you're not exactly overpaying, and you still get strong dividends. On the dividend side of things, its forward dividend yield is 5%. Historically, it's trending between 4.5 to 5-ish somehow, and historical payout ratio is 60%, like what I've said, but just now on the screen earlier, I don't know why it's showing 50%. The last dividend I got from them was 57 cents, and it pays out its dividends semi-annually. On a quick overview, you can see the dividends per share paid over the last 5 years as well. It's on an increasing trend. And if you want to take a look at the dividend yield, yes, this is the yield curve chart basically of where it was historically and right now. I think it's in the sweet spot of where I would like it to be. If it goes higher, I mean, it's good, but at what kind of cost, right? What does it need to do? Give more special dividends, give more capital returns? I don't know. As long as it doesn't tweak too much of its payout ratio, I think I'm fine with that. But with the basis that the bank continues to perform based on what it's already doing well, right? So, like I said earlier, this is how you can actually have a quick overview of its dividend payout history, and that's why I like to use Beansprout for this purpose. Comparing the three local bank stocks, you can see that they've all done really well over the last 5 years for its shareholders. DBS leads the pack at 126.4%, and although year to date the three banks have not outperformed the market. DBS also leads the pack at 2.8%. In the forward yield section, you can see that DBS stands at the highest at 6.6%, and recent digging have shown that the payout, because of its inclusion of a 15-cent capital return to its shareholders, this resulted in that spike to 6.6% in the yield. What does that mean exactly with that 15 cents capital return? It essentially brought its payout ratio from 59%, which is just the ordinary part of the dividend at 60 cents, to 74% of its quarterly earnings, which is very aggressive if you ask me. So for its shareholders, I do not think that it's reasonable to expect such high payout ratio moving forward. It will normalize in terms of its yield back to probably the 5-ish to 6% kind of yield, which is more reasonable. And right now its price to book ratio is also the highest among the three local banks. So given a chance, I would definitely want to have a position in DBS, but just not right now. For UOB, I will consider that when I have more resources, but right now it's still OCBC. The three local banks are eventually like Pokemon, right? That I would want them in my portfolio, but at the appropriate time. If you like what you have seen so far, please help me by liking and subscribing, and I will go on to talk about other stocks in the portfolio in the next video. Thank you for watching and have a good week ahead.